Good morning. As the sun rises over Europe, a sense of unease settles over the continent's financial centers. European markets opened to a wave of red this Monday, January 19th, 2026, as investor optimism quickly faded. The early hours saw a sharp sell-off, with traders reacting almost instantly to overnight developments. Major indices across the UK, Germany, and France all dropped at the open, signaling a continent-wide concern. The FTSE 100, DAX, and CSE 40 each lost significant ground, reflecting widespread uncertainty. The coordinated downturn points to a global issue, not just a local blip. Investors are increasingly aware that shocks in one region can ripple across borders in seconds. Trading floors were tense, with investors selling off riskier assets and seeking safety. The mood was cautious, as many shifted their focus to more stable investments like government bonds and gold. The trigger? Fresh geopolitical tensions from the United States. Overnight headlines dominated conversations, leaving many to wonder what might come next. President Donald Trump's renewed interest in Greenland and threats of sanctions have rattled markets. His comments have reignited debates about global trade and political stability. The mere suggestion of sanctions has disrupted the fragile balance, sending shockwaves through financial systems. Investors are now bracing for potential policy changes and their far-reaching consequences. This is a stark reminder of how quickly political statements can impact economies and investments. Even a single remark can trigger volatility, affecting millions of portfolios worldwide. As we move forward, let's look closer at what's driving this anxiety and how investors and policymakers might respond to these rapidly changing events. The main cause of today's market jitters is President Trump's revived ambition to acquire Greenland. Over the weekend, he warned of possible U.S. sanctions against countries blocking his efforts, putting Denmark and the EU on edge. The threat of sanctions injects uncertainty into global trade and alliances, unsettling investors. With no clarity on what form sanctions might take, companies face the risk of disrupted supply chains and higher costs. The fear is this could escalate into a broader US-EU trade dispute, with damaging consequences for both economies. This is a textbook example of how political drama can trigger immediate market volatility. Today, Europe is feeling the full force of the so-called Trump effect. Let's break down what's happening across Europe's major stock markets this morning, as investors wake up to a wave of uncertainty and shifting sentiment. The numbers from this morning's trading session paint a clear picture of caution and concern rippling through the financial sector. The UK's FTSE 100 opened down 0.1%. While this is a relatively modest decline, it's a sign that British investors are treading carefully, weighing both domestic and international risks as they navigate a volatile environment. Germany's DAX, on the other hand, fell by a full 1%. That's a sharp move for such a major index, and it highlights growing fears about the health of Germany's export-driven economy, especially as global trade tensions escalate. France's CAC 40 dropped even further, down 1.4%. This steeper decline reflects mounting anxiety over the prospects for France's multinational giants, who are particularly vulnerable to disruptions in global supply chains and shifting trade policies. The steeper declines in Germany and France suggest that mainland Europe feels more exposed to the threat of U.S. trade actions than the UK does, with investors in these countries reacting more strongly to the latest headlines. Taken together, these moves tell a unified story. European investors are bracing for potential fallout from U.S. political maneuvers, and the mood is one of heightened caution. The FTSE's smaller dip may reflect unique UK factors, such as a different economic outlook or less direct exposure to certain global risks. But the overall trend is unmistakable. Uncertainty is bad for business, no matter where you are. As a result, investors across the continent are pulling back, choosing to wait on the sidelines for more clarity before making any big moves or new commitments. The message from the markets is unmistakable. Political risk is now the dominant force driving this sell-off, overshadowing even economic fundamentals for the moment. With so much at stake, let's take a closer look at how currencies are reacting to this wave of uncertainty and what it could mean for investors going forward. Amid falling stocks, the British pound actually edged higher, up 0.07% against the US dollar. This isn't a sign of UK strength, but rather US dollar weakness, as Trump's threats make the dollar less attractive. Currency markets are all about relative strength. Today, the pound simply looks better by comparison. When the dollar weakens, it takes more to buy a pound, pushing the exchange rate up. Investors are seeking alternatives to the dollar amid US-driven uncertainty. A stronger pound makes imports cheaper but can hurt UK exporters. It's a reminder that currency moves are complex and often driven by global politics, not just local news. The pound's gain is a double-edged sword for the UK economy. Let's turn to some standout company stories. Despite the market gloom, some companies are bucking the trend. Dole's Group beat its own forecasts for 2025, with strong revenue growth, though currency headwinds trimmed results. Investors welcomed the solid performance, even with global challenges. Ashtead Technologies shares soared nearly 12%, after reporting a 21% jump in revenue and profits ahead of expectations. These results show that individual success stories can shine, even on a tough day for markets. Positive company news can still attract investors, regardless of the wider market mood. Let's look at more movers and shakers. Big Technologies saw its shares surge over 16% after settling a long-running legal dispute. The settlement removed a major cloud of uncertainty, giving investors confidence to buy. In contrast, Marshall's shares slipped 2% after reporting results in line with expectations. Meeting forecasts wasn't enough to excite investors in a nervous market, especially in the construction sector. The dip reflects broader worries about economic slowdown and demand for building products. In today's climate, removing uncertainty is often rewarded more than steady results. Even solid companies can see their shares fall if the outlook is cloudy. Let's check in on more corporate headlines. 9. MNC Saatchi shares rose over 6% after meeting its full-year guidance, showing strong management in a tough market. Investors value companies that deliver on promises, even if revenues dip. Workspace Group's CEO stepped down suddenly, but the company quickly named a respected industry veteran as successor, calming nerves. W.H. Smith announced Leo Quinn as its new executive chairman, bringing in proven leadership. These leadership moves signal a focus on stability and strategic direction. In uncertain times, experienced management and clear communication can boost investor confidence. Companies that act decisively are rewarded. Let's clarify some key financial terms you've heard today. 9. Let's break down a few key financial terms. Guidance is a company's forecast for future performance. Meeting it signals good management. Revenue is total sales before expenses. Growth here means more customers. Profit is what's left after costs, crucial for reinvestment and dividends. Like for like compares performance year over year, excluding new stores or closures, to show true business health. These terms help investors judge if a company is really growing or just expanding. Understanding these basics makes financial news much clearer. Now, what does all this mean for you? So, how does today's market turmoil affect you? Whether you're following the headlines or just going about your day, these shifts in the financial world can have a real impact on your daily life, even if you don't always notice it right away. If you have a pension or investments, a dip in the FTSE 100 can impact your savings, though these are long-term holdings. While it's normal to feel uneasy seeing your balance fluctuate, remember that markets often recover over time. Staying patient and not making hasty decisions is usually the best approach. Nervous markets can slow economic growth as businesses delay investments and hiring. Companies may put big projects on hold, and job opportunities could become scarcer, especially if uncertainty drags on for weeks or months. Consumer confidence may fall, leading to less spending and more caution. When people worry about the future, they tend to save more and cut back on non-essential purchases, which can affect local shops and the wider economy. The pound's movement affects holiday costs and import prices, but can challenge UK exporters. A weaker pound means trips abroad get pricier, and imported goods cost more, but it can also make British products more attractive to overseas buyers. Today's events show how global politics can ripple through to your wallet. Decisions made in distant capitals can influence your bills, your job, and even the price of your weekly shop. The key is not to panic. Markets rise and fall, and long-term goals matter most. Speaking to a financial advisor or simply reviewing your plans can help you feel more in control during uncertain times. For the UK, navigating global uncertainty will be a major challenge this year. Policymakers and businesses alike will need to adapt quickly, making decisions that balance stability with growth. Stay informed, stay focused, and remember, world events are closer to home than you think. By understanding these connections, you can make smarter choices for yourself and your family. Thanks for watching.